We're going to be looking at the different types of fixed income funds in this video. Before we look at the details, I want to provide a couple of clarifications. The holding period shown is indicative. There is some flexibility allowed. Where you see a single value, that's meant to be the outer limit. Where you see a range of values, the holding period should ideally be within that range. The holding period is important because it tends to match the holdings of the fund. This reduces risk and volatility. The risk level shown is also indicative. Risk levels can vary from one AMC to another for the same fund type, as the securities held in the fund determine the actual risk. We covered the riskometer and the various risk levels in the last video. If you have any doubts, please review that video. The first fund type we're looking at is overnight funds. These are the safest funds available. They give the lowest returns, but also have the lowest risk. These are ideal for very short holding periods. Liquid funds come next. These are also very safe funds and can be held for up to 3 months. Risk levels can vary from low to moderate. As we have discussed previously, these funds are also used for systematic transfer investments so that money can periodically be moved to a riskier fund and costs can be averaged. We then look at ultra short funds. These are ideal for a holding period of up to 6 months. They have a moderate risk level. Low duration funds are next. These tend to have a holding period of about a year. They also have a moderate risk level. Money market funds. These are very safe funds where the securities held mature within a period of about 6 months. So the fund also should be held for about 6 months. The risk level is moderate. Short duration funds. These have a holding period of about 1 to 3 years and they also have a moderate risk level. Medium duration funds are next. These should ideally be held for up to 4 years. Risk levels can go up to moderately high in this category. We then look at medium to long duration funds. These should be held between 4 and 7 years. These also ideally have moderate risk levels. Long duration funds. These should be held for more than 7 years. They also have moderate risk levels. We now look at dynamic bond funds. In these funds, the fund managers have the flexibility to choose the average maturity of the bonds in this fund. If they feel that the longer tenured bonds will do better, they will buy those and increase the average maturity of the securities in the fund. Average maturity of a fund is defined as the weighted average duration to maturity of the bonds held in the fund. Corporate bond funds. These funds invest only in bonds issued by companies. They ideally should be held between 1 and 3 years and risk levels are moderate. Credit risk funds. We covered credit risk in the last video. These are funds that buy corporate bonds with undervalued credit ratings in the hope that the bonds will be upgraded, leading to a rise in value. Risk levels can go up to high in this category. We now look at banking and PSU funds. These funds invest in bonds issued by public banks and other entities. The holding period should be 1 to 4 years and the risk level is moderate. Gilt funds are next. These funds invest only in government issued securities and are considered much safer. Holding period is 3 to 5 years. Risk levels are moderate. And lastly, floater funds. These are funds where the coupon rate of a bond changes instead of the price of a bond in response to systemic interest rate changes. This reduces risk and volatility significantly. Risk levels are ideally moderate and the fund can be held for up to 5 years. I hope this video was useful. Please do contact me at the email address provided, which is adit@aditshah.in, or call me on my mobile. The number is 98675 87495. Do visit my website, which is www.aditshah.in. Links to my social media handles can be found here. Please follow me. Thanks for taking the time to watch this video.